What if there was an AI that could predict the stock market with near-perfect accuracy? Imagine knowing which stock will rise tomorrow, which company will crash next month, when the next market rally will begin. It sounds like science fiction or a billionaire's secret weapon, but headlines keep appearing. AI beats Wall Street. Algorithm outperforms hedge funds. Machine learning predicts market trends. So the real question is this AI actually real, or is it just another hype cycle? Today, we're breaking down the truth behind AI stock prediction and whether it can really forecast the future. The stock market has always been about prediction. Investors analyze data, study patterns, read earnings reports, and try to anticipate what happens next. But humans have limits. We can't process millions of data points instantly. We can't track global news, social sentiment, macroeconomics, and company fundamentals all at once. AI can. That's why major hedge funds, banks, and trading firms are investing billions into machine learning systems. But here's the catch. Analyzing data is not the same as predicting the future. Let's separate myth from reality. What AI predicting the market actually means. First, we need clarity. AI does not see the future. What it does is analyze historical data, detect patterns, and calculate probabilities. Machine learning models are trained on years, like sometimes decades, of price movements, earnings reports, trading volumes, news articles, and even social media sentiment. They look for correlations humans might miss. For example, an AI might detect that certain volatility patterns often occur before earnings surprises, or that unusual options activity tends to precede large price swings. It's not magic, it's advanced statistical pattern recognition. And even when patterns are identified, they represent probabilities, not guarantees. A 65% likelihood of a price increase still means a 35% chance of being wrong. That uncertainty never disappears. Who is actually using AI in trading? This isn't theoretical. Major firms are already doing it. Quantitative hedge funds like Renaissance Technologies have relied on algorithmic strategies for decades. Firms like 𝐓𝐢𝐦𝐞𝐬𝐭𝐚𝐦𝐩 use machine learning models to analyze massive data sets and execute trades. Even global asset managers like BlackRock use AI-driven systems such as Aladdin to manage portfolio risk and monitor markets in real time. These firms employ mathematicians, physicists, and AI researchers, not traditional stock pickers making gut decisions. So yes, AI in finance is very real. But it operates within highly competitive environments where tiny advantages matter, and those advantages are constantly shrinking as competitors improve their own systems. Can AI beat the market consistently? This is where things get complicated. Markets are influenced by economic data, geopolitical events, corporate earnings, interest rates, investor psychology, and unexpected global crises. AI can model historical patterns, but it struggles with black swan events, rare, unpredictable shocks that reshape markets overnight. When global crises hit, correlations break down. Historical data becomes less reliable. AI performs best in structured environments with repeatable patterns. Financial markets are not always structured. They are driven by human emotion as much as data, and human emotion is notoriously hard to quantify. The power of speed and high-frequency trading. Where AI truly dominates is speed. High-frequency trading firms use algorithms that execute trades in microseconds. They don't try to predict long-term trends, exploit tiny pricing inefficiencies that exist for fractions of a second. Humans cannot compete at that scale. This is where AI has an undeniable edge. Not in predicting the future years ahead, but in executing strategies faster and more precisely than any human ever could. In this arena, even a millisecond advantage can translate into millions of dollars. Retail investors and AI tools. Now let's talk about everyday investors. There are AI-powered platforms claiming to predict stock movements using machine learning. Some offer automated portfolios. Others promise sentiment-based forecasting. The reality is more nuanced. Most retail AI tools rely on simplified models. They can improve research efficiency and highlight patterns, but they don't have access to the same proprietary data or computational resources as major hedge funds. AI can assist with screening stocks, analyzing financial statements, detecting unusual volume activity, and managing diversification, but it does not eliminate uncertainty or guarantee success. If it were that easy, everyone using the tool would be rich, and markets would stop functioning normally. Why the market is so difficult to predict. The stock market is a complex adaptive system. When participants discover a profitable pattern, they act on it, and that action removes the opportunity. If an AI finds a reliable trading signal and exploits it, competitors quickly replicate it. The edge shrinks or disappears entirely. Markets constantly evolve, the more predictable they seem. the faster that predictability fades. This feedback loop makes long-term dominance extremely difficult. The real advantage of AI in finance. The biggest benefit of AI isn't perfect prediction, it's emotional discipline and data efficiency. AI doesn't panic during market crashes. It doesn't get greedy during rallies. It follows probability-based models. Human investors often make irrational decisions driven by fear or overconfidence. AI reduces emotional bias and processes information without psychological noise. That consistency can improve long-term performance, even if it doesn't guarantee wins. Over time, disciplined probability-based decisions tend to outperform emotional reactions, the risks and ethical concerns. As AI trading becomes more advanced, new risks emerge. Algorithmic trading can amplify volatility if multiple systems respond to the same signals at once. Flash crashes have occurred when automated programs triggered massive sell-offs within seconds. Regulators continue debating how to oversee AI-driven financial systems, because when machines control billions of dollars, small coding errors or flawed assumptions can create massive consequences. The more automated the system, the faster mistakes can spread. So is the stock predicting AI real? Yeah, but not in the way headlines suggest. AI can analyze enormous data sets. It can detect subtle correlations. It can optimize trade execution. It can manage risk dynamically, but it cannot eliminate uncertainty. It cannot perfectly predict black swan events. It cannot guarantee profits. It is a tool, a powerful one, but still limited by probability, competition, and the unpredictable nature of global events. So, is there an AI that predicts the stock market? Yes, in the sense that powerful algorithms analyze patterns and calculate probabilities better than any human could alone. No, in the sense that no system can see the future with certainty. The stock market is influenced by data, but also by human emotion, global politics, innovation cycles, and unexpected shocks. AI is reshaping investing. It's changing how Wall Street operates, it's accelerating analysis and improving execution. But it hasn't unlocked perfect foresight, and maybe that's the truth most people don't want to hear. The stock market isn't a puzzle waiting to be solved by a supercomputer. It's a dynamic battlefield of probability. AI doesn't remove risk. It simply changes how intelligent